I'm Charlotte McLeod with the Investing News Network, and here today with me is Marc Lichtenfeld, Chief Income Strategist at the Oxford Club. Thank you so much for joining me online. Great to see you.
Yeah, great to see you, Charlotte.
Really nice to have you back here after a couple of years. Lots to catch up on for sure. And where I thought we could begin is with your macro take on the U.S. economy. So lots of questions about what's going on there, especially after last week's inflation data. We had previously had many people talking about a recession coming in 2023. Just want to get your take on what you see happening there, the big picture.
Sure. So as you mentioned, yeah, there are still lots of people who expect a recession, and I've been backing off of those claims or that forecast for a while now, really based on a few things. One is the near record low unemployment in the United States. Unemployment is still very low. It is still very difficult to find qualified staff for companies. Almost every company is having a difficulty with that. Wages are increasing. So it's difficult to have a recession in just with a situation where everybody's working and getting paid more. So then you also look at the stock market, and the stock market is a forward-looking indicator. And so the market has been white hot for the past 6 months or year to date, really. And if you believe what the market is telling you that things are not going to be quite so bad. It doesn't necessarily mean that the economy will be as hot as the market. It's not exactly correlated. But generally speaking, if everybody's coming into this year was very worried about recession, and then the market takes off the way it has, that's a strong signal that we may not get that recession that we're all expecting. Now, on the other hand, though, we do have some other indicators that suggest there is a recession perhaps on the horizon. You have the inverted yield curve, which historically has been a pretty solid indicator of recession. There's a saying that the inverted yield curve has predicted 20 of the last 10 recessions. So every recession has been accompanied by an inverted yield curve, but not necessarily every inverted yield curve was followed by a recession. So that is something to consider. I'm also keeping an eye on Chinese producer price index. Those prices are coming down, and the Chinese are blaming the United States for more protectionism, and therefore China is exporting less to the United States and perhaps other countries. So their prices are coming down. Regardless of what the cause is, if those prices continue to come down, that should also bring prices further down in the United States. And at this point, it's a little difficult to see exactly what effect that will have, but I think it's really something worth keeping an eye on.
Definitely. I think so important to look at those two sides of what could be coming as you've been laying out for us. The other point I want to bring up is what's going on with the U.S. Federal Reserve. We have the next meeting coming up next week, and they've been indicating that probably we'll get 2 more hikes in 2023, likely 25 basis points each. And now, though, with last week's inflation data, I think people are wondering, okay, is that really going to happen? So what's your take on what we could see?
Yeah, if I had to guess, I would say, which I guess you are making me guess, I would expect a pause, but that's not a real confident prediction. The Fed has been very clear from the beginning that they are going to do whatever it takes to bring down inflation. And so far, inflation is coming down. It's come way down. So, we're certainly not at the 2% level that they would like to see, but we are certainly moving strongly in that direction. So whether they continue to kind of step on the brakes and try to get us down that low, or if they kind of wait and see what happens, it's really not clear. Like I said, I would guess that they're going to pause just because I think they want to be careful about not tipping us into recession. So I'm going to guess that they're going to pause at the next meeting, but like I said, it's not a real confident guess.
Yeah, it's definitely feeling very tricky to get a sense of what's going on there. I also want to bring up gold. So we've talked in the past about the role that gold can play in an investor's portfolio, and we have a lot of interesting potential drivers for gold in 2023. So Could you tell me what you make of the market so far and where we could be heading in the rest of the year?
Sure. So I'm bullish on gold, and as you may remember, I'm not a permabull when it comes to gold. I'm not somebody who always thinks that gold is the best thing you could possibly have in your portfolio. In fact, many times I feel the opposite, though I do believe that most investors should have some exposure to gold, a very, very small percentage, but just as an uncorrelated asset to the stock market. That being said, for right now, I am bullish on gold. The main reason is the US dollar has been falling. We were near, 20-year highs not that long ago, but it has been falling pretty rapidly over the last few months. And so gold is a great hedge against that. Also, even though inflation is coming down, it had been significantly higher. And just in general, for the long term, gold is a good hedge against inflation. So if you do believe that there is still some inflation left to be worked out, then gold is then that's another reason to own some gold. And lastly, I'm generally bullish on most metals because of strong demand for industry, strong demand by the consumer. So I think metals, and particularly gold, are a very good place to be right now.
Okay, and I always love to hear from people who are not always bullish on gold and get that perspective. I think that's really important. Is there anything more that you can say about being bullish on kind of the metals complex at the moment? I think that's an interesting point to pick up on.
Yeah, I'm very bullish on the industrial metals too. Copper, zinc, nickel is a metal I'm bullish on, and basically because of if we do not go into recession, as I don't believe that we will, then the consumer demand right now is very strong. Industrial demand is very strong, and as we have this kind of resurgence of the economy, still coming out of the pandemic a little bit, I do think that we're going to see strong demand for the metals, and especially if President Biden is reelected next year, because the Inflation Reduction Act is a big infrastructure stimulus bill. And it's been put into place, and that's leading to a lot of this demand for metals. So if he is reelected, and the IRA is not disrupted by whoever the next president is, then that money will continue to be spent and increase demand for these metals for a while.
Okay, a lot of great points there. And how would you recommend that investors look at getting exposure to these markets?
Well, the simplest way, if you want to own gold, I think is an ETF like GLD. You can certainly go for the miners if you want to take on a little bit more risk. If you want to take a lot more risk, you can go for some of the junior miners. But I think for most people, just owning something simple like GLD in a little bit of their portfolio gives them that exposure to the metals. And there are also various mixed metals ETFs or even closed-end funds or mutual funds. But I like to generally keep it simple for most investors. And you buy the GLD, the SLV for silver, or some of the other things like that.
Right. Depends on your skill level and what you're looking for. So everybody has to decide that themselves.
Exactly.
All right. All right. So we've gone through kind of what's going on in the metals. I know that you also have a really big focus on dividend investing. So definitely want to get your thoughts there. Also, I believe earlier this year, you had a new edition of your book, Get Rich with Dividends, come out. So I want to hear a little bit about that strategy and how you're using that in 2023. What should people know about that approach?
Sure. So the strategy that I use in Get Rich with Dividends and my newsletter, the Oxford Income Letter, is a dividend growth strategy. And basically, we're looking for companies that raise their dividend every single year. And the reason for that is twofold. One, if you're collecting the income today, then you're getting a raise every year. And when I first wrote the book, the first edition came out in 2012, and for 10 years almost, we had pretty much no inflation. And really the kind of the concept behind this dividend growth strategy is that if you're getting a raise every year from your dividends, then you're keeping up with or beating inflation. Well, inflation wasn't really on people's minds for so many years. Once 2021, 2022 hit, and we started getting some significant inflation, then suddenly maintaining your buying power was really important. So that strategy has withstood the test of time. The other reason I love this strategy is for investors who don't need the income today. So they're either working, they have other sources of income, and they can compound their wealth by reinvesting the dividends. And what that means is you automatically reinvest the dividends. So you don't receive a check or a deposit in your account and then decide which stock to buy with it and when. It just automatically goes right into the stock. And by doing that, you compound your wealth so much faster because you're taking emotion out of the strategy. You're not thinking, well, the market's too high right now, I'm going to hold off, or it's too low right now, the stocks are getting killed, I'm going to wait till things are better. And obviously most people pick the exact wrong time to do that. So by doing it automatically every quarter, every time that dividend is paid, you compound your wealth, and the numbers can really get quite staggering if you hold for a number of years and just let these dividends grow and grow and grow, and especially as those dividends increase every single year. So that's really the basics of the strategy.
Right. Okay. Thank you for outlining that. The other question, and I'm sure that I've asked you this before, and usually we get quite an interesting answer. Where are you seeing the most attractive dividends right now when it comes to sectors that you're looking at?
So I really like the energy sector right now. The energy sector has not been one of the leaders this year. So you can find some really good quality dividends that are fairly high. A company like Enterprise Products Partners, which pays about 7.5%, which is fantastic. Real quality company. And then some of the big producers, a company like Chevron, who's admittedly the stock has not done great, but pays a pretty decent dividend. I also like healthcare right now. A company like AbbVie, which has been my favorite big pharma company for a long time, pays over 4%. And it's just a company that has been misunderstood for years and years and has a lot of great products coming out or that are already blockbusters and will continue to grow. And there are quite a few drug companies out there that pay a solid dividend, that grow that dividend every single year. And I really like the healthcare sector. It's a recession-proof sector, obviously. So I think it's a really safe place to be for the long term.
Very interesting. And I want to take you back to energy just for a moment, because that is something that I've been hearing about lately is oil and gas stocks that are able to pay these dividends. And to me, it seems like that's a shift from maybe how it used to be. I wondered if you could talk a little bit about why we're seeing that right now and how come that's happening.
Yeah, I think it's because investors are demanding it, basically. Especially as oil prices slumped, there was really a focus on preserving capital and taking care of shareholders, and it was because the shareholders demanded. They were tired of this kind of feast and famine cycle that so many oil companies go through. And as soon as oil prices go high, they increase their investment, and as soon as prices sink, they scale way back. And I think investors really wanted something more consistent. So the companies are having to manage their capital more effectively and consistently, and as a result are paying these dividends fairly consistently. And in some cases, especially for the companies like Enterprise and Chevron, that they have been raising their dividends for years and years. I mean, we were talking several decades. But even companies that haven't been that consistent, you are seeing that demand from shareholders. So another reason that I think energy sectors is a good place to be, because I think that will continue for a while. If energy prices explode and we see oil, back above $100, maybe those big profits are enough for investors and they stop demanding the dividends the way they are right now. But at least in the time being, and I think for the at least immediate future, we are going to see this emphasis on consistent dividends.
Really interesting. And all right, so we've talked about the sectors that you like right now, things that you think work. I do also want to touch on the other side of that, which are markets that you are staying away from, areas that you would recommend that investors not touch right now.
Yeah, I think office REITs are scary right now. It's really hard to imagine how a lot of these office buildings and as a result office REITs will succeed. I'm not saying that they're all going to implode, but it's hard to imagine how they're going to do well. Now, very often markets do, what you don't expect them to do. So I'm not sitting here saying they're absolute trash and dump all your office REITs. But that being said, I'm having a hard time picturing how they succeed. So I'll need to see some more evidence that they are going to be able to meet their obligations, that their tenants are going to meet their obligations, because the news is so full of stories of major tenants pulling out or not paying their rent or not renewing their leases. So we're going to have to see, especially the ones that own properties in major cities, major metropolitan areas like San Francisco, New York, where we are seeing, return to office isn't coming back quite as robustly as perhaps we thought it would at the beginning of the pandemic. It's, we're still, I think we're all trying to figure out how the new work environment is going to look. And so that kind of uncertainty makes me concerned about the office REITs.
That makes a lot of sense. And as we're finishing up, I think we can tell even from this brief conversation that we are trying to figure out a lot of things right now. So are there any final pieces of advice that you would leave investors with heading into the back half of the year?
Yeah, I think it's important to remember that it's not different this time, because every crisis, every situation is a little bit different. But the market does go up over the long haul, and I think we only have to look back at the pandemic. In March 2020, when stocks absolutely got annihilated for about a month, for very good reason. I mean, the entire global economy had shut down. I mean, even forgetting the scariness of the virus itself and how many people were going to get sick and perhaps die, but just the fact that the global economy had shut down. So there was a very good reason that stocks fell off a cliff, and then they came right back. And, we have seen this over and over again, the Great Recession, which was, again, a very scary time and for very good reason. I mean, we were close to financial Armageddon, the dot-com bust. So we have all these crises, and there are legitimately scary things out there that could tank the market at any time. But it's really important to remember that the market does go up over time. And, if you had stayed in stocks after the pandemic, or, after that initial sell-off, you did great. And if you had stayed in stocks during the Great Recession, it took a little while to be made whole, but eventually you made a lot of money over the years. So, as long as you have a long-term time horizon, it's really important to remember the next scary thing, the next time stocks take a big tumble, it's really important to remember to stay the course, because we do know that stocks go up over the long term, and it hasn't been different this time in, well over 100 years. And we've had all kinds of, very serious crises during that period.
All right. I think that sounds like a good note to wrap it up. So thank you so much for coming on to talk today. Great to get your perspective about what's going on in the markets.
Yeah, always great to talk to you. Thanks for having me on.
Really nice to talk to you again. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Marc Lichtenfeld with the Oxford Club. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.